What if the next financial shock does not begin on Wall Street? What if it begins thousands of miles away in Japan? Right now, traders around the world are watching something they have not seen in decades. Japan's massive bond market, worth nearly $7.6 trillion, is showing signs of serious stress. Yields are rising. Investors are becoming nervous. And many analysts are asking one critical question. If Japan loses control of its bond market, could America be next? More importantly, what could this mean for gold and silver investors? Stay with me, because the answer could completely change the way you look at the global economy. Most investors spend their time watching the Federal Reserve or the US dollar. Those are certainly important, but some of the biggest market shifts in history have started in places very few people were paying attention to. Today, Japan has become one of those places. Japan has always been viewed as one of the safest bond markets in the world. For decades, investors believed Japanese government bonds were among the most stable financial assets available. Interest rates remained close to zero. Inflation stayed very low. The Bank of Japan controlled borrowing costs with remarkable consistency. Markets became comfortable believing that nothing dramatic would ever happen. That belief is now being challenged. Bond yields in Japan have been moving higher at a pace that has surprised many professional investors. While these numbers may seem technical, they represent something much bigger. Rising yields mean investors are demanding more compensation to lend money to the Japanese government. That may sound normal, but after decades of ultra-low rates, this change has enormous consequences. The Japanese government carries one of the largest debt burdens in the developed world. Because of that, every increase in borrowing costs matters. Even a small rise in yields can increase the amount of money needed just to pay interest on government debt. That creates a difficult balancing act. If rates continue rising, borrowing becomes more expensive. If the central bank steps in too aggressively, inflation concerns may return. If officials do nothing, investors may continue demanding even higher yields. Markets are now watching every move very carefully. The reason this matters outside Japan is because Japan is not an isolated economy. Japanese banks, insurance companies, pension funds, and investment firms manage enormous amounts of global capital. They own assets around the world, including large amounts of US Treasury bonds, corporate debt, international stocks, and many other investments. When financial conditions change inside Japan, these institutions sometimes adjust their global portfolios. Those decisions can influence markets far beyond Japan's borders. Imagine a large Japanese pension fund that suddenly finds it can earn better returns at home because domestic bond yields have increased. Instead of buying foreign bonds, it may begin moving money back into Japan. That process is often called capital repatriation. While it sounds simple, the impact can be significant. Selling foreign assets means fewer buyers for overseas bonds. If enough institutions make similar decisions, bond yields in other countries may also begin rising. That is exactly why traders in New York, London, Singapore, and Frankfurt are paying such close attention to Japanese bond markets. Now let us connect this to the United States. America depends heavily on strong demand for Treasury securities. The U.S. government continues issuing new debt to finance spending. Every auction requires buyers. Those buyers include domestic investors, foreign governments, central banks, commercial banks, insurance companies, and large institutional funds. If foreign demand weakens even slightly, Treasury yields may move higher. Higher Treasury yields affect almost everything: mortgage rates, business loans, credit cards, corporate borrowing, government financing, consumer spending, and stock market valuations. This is why bond markets often have a greater influence on the economy than stock markets themselves. The bond market quietly sets the cost of money. When money becomes more expensive, economic activity usually slows. This relationship has existed for decades. Now, another important factor enters the picture: inflation. For years, central banks around the world focused on keeping inflation under control. Following the global pandemic, inflation surged across many economies. Central banks responded by raising interest rates aggressively. Those higher rates helped reduce inflation, but they also increased borrowing costs. Today, inflation has cooled compared with its highest levels. However, policymakers remain cautious. They know inflation can return unexpectedly. If inflation remains stubborn, central banks may keep interest rates higher for longer. That creates additional pressure on bond markets. Japan now faces a situation it has not experienced in many years. Inflation has returned after decades of relatively stable prices. Workers are receiving larger wage increases. Businesses have raised prices. Consumers are adjusting to a different economic environment. The Bank of Japan has already started moving away from its extremely loose monetary policies. That shift alone represents one of the biggest changes in global finance during recent years. For decades, Japan provided cheap money to global markets. Investors borrowed Japanese yen at very low interest rates and invested elsewhere seeking higher returns. This became known as the yen carry trade. As long as Japanese rates remained extremely low, the strategy worked well. But when Japanese interest rates begin rising, that trade becomes less attractive. Investors may reduce those positions. That can create volatility across global financial markets. Some analysts believe this process has already started. Others believe the largest adjustments are still ahead. Either way, investors are watching very closely. Now consider the United States. America also faces growing government debt. Budget deficits remain significant. Treasury issuance continues increasing. The Federal Reserve has reduced some of its bond holdings compared with previous years. That means private investors must absorb more government debt. If global demand weakens while supply continues rising, yields could remain under upward pressure. This is one reason economists carefully monitor foreign buying of US Treasuries. Japan remains one of the largest foreign holders. Any meaningful shift attracts immediate attention. The question investors now ask is not whether Japan alone can move global markets. The question is whether Japan's changing bond market reflects a much broader trend. Could investors worldwide begin demanding higher yields? Could governments face rising borrowing costs? Could financial conditions tighten globally? These are the questions driving today's market conversation. Gold investors are paying especially close attention. Gold often responds not only to inflation, but also to confidence in government debt and monetary policy. If investors become concerned about long-term fiscal stability, demand for safe haven assets may increase. That does not mean gold rises every day. Markets rarely move in straight lines, but changing confidence can gradually influence long-term trends. Silver adds another interesting dimension. Unlike gold, silver benefits from both investment demand and industrial demand. Modern industries require enormous quantities of silver. Solar energy, artificial intelligence infrastructure, electric vehicles, medical equipment, advanced electronics, high-speed communications. These sectors continue expanding around the world. If investors also increase demand for physical silver, the market could become increasingly tight. This combination has attracted growing attention among analysts. The next few months may therefore become extremely important. Japan's bond market may appear distant to many American investors. In reality, it could provide valuable clues about the future direction of global interest rates, currencies, and precious metals. And that is exactly why experienced investors never ignore developments happening on the other side of the world. The story becomes even more interesting when we compare Japan's situation with what is happening in the United States. Both countries have large government debt. Both rely on investors to purchase government bonds. Both central banks have faced the difficult challenge of balancing inflation, economic growth, and financial stability. But there are also major differences that investors should understand. The United States issues the world's primary reserve currency. That gives America advantages that few countries enjoy. Global trade, international banking, commodity markets, and foreign exchange reserves all rely heavily on the US dollar. Because of this, the United States usually experiences strong demand for Treasury securities even during periods of uncertainty. However, that advantage does not eliminate every risk. Markets constantly evaluate whether government borrowing remains sustainable. As debt levels increase, investors naturally pay closer attention. Confidence becomes one of the most valuable assets any government can possess. Once confidence begins weakening, markets often react quickly. That is why bond traders closely watch every Treasury auction. Strong demand usually calms markets. Weak demand often raises concerns about future borrowing costs. Now imagine a situation where Japanese investors gradually reduce purchases of foreign bonds because domestic yields become more attractive. Other global investors would need to fill that gap. If they demand higher returns, Treasury yields may continue rising. Higher yields affect financial conditions throughout the economy. Housing markets could slow. Corporate borrowing becomes more expensive. Consumer credit costs increase. Economic growth may gradually lose momentum. Stock market valuations may also come under pressure because higher interest rates reduce the present value of future earnings. This relationship explains why equity investors also watch bond markets every day. Sometimes bond markets send warning signals long before stock markets react. History offers several examples. Financial stress often appeared first in credit markets. Only later did equity markets fully recognize the changing environment. That is why experienced investors rarely ignore fixed income markets. They understand that bonds often reveal changing expectations before headlines become obvious. Another important issue involves currency movements. If Japanese yields continue rising, the Japanese yen could strengthen over time. A stronger yen changes global investment decisions. Currency fluctuations influence exports, imports, corporate profits, and international capital flows. The US dollar may also react depending on relative interest rate expectations between the Federal Reserve and the Bank of Japan. Dollar strength has always been closely connected with precious metals. When the dollar rises, gold and silver often face temporary resistance. When the dollar weakens, precious metals frequently receive additional support. This relationship is not perfect, but it has influenced markets for decades. Now let us consider the Federal Reserve. Every policy meeting receives worldwide attention. Investors analyze every statement, every press conference, every forecast. Even small changes in language can influence expectations. If the Federal Reserve signals that interest rates may eventually move lower, Treasury yields could decline. Lower yields generally improve the outlook for gold because the opportunity cost of holding non-yielding assets becomes smaller. If inflation unexpectedly rises again, the situation becomes more complicated. The Federal Reserve may need to keep policy tighter for longer. Higher rates could support the dollar while creating temporary pressure for precious metals. Yet if investors begin worrying that higher rates will eventually weaken economic growth, gold may again attract safe haven demand. This demonstrates why gold rarely responds to only one factor. Markets constantly evaluate inflation, interest rates, economic growth, currency strength, geopolitical risk, government debt, investor confidence, all at the same time. Silver brings another layer of opportunity. Industrial demand continues expanding across several sectors. Artificial intelligence requires advanced semiconductor manufacturing. Data centers consume enormous amounts of electronic equipment. Electric vehicles require highly conductive components. Renewable energy systems depend heavily on silver. Medical technology uses silver because of its unique physical properties. These industries continue growing, regardless of short-term market volatility. Meanwhile, global silver supply has struggled to expand rapidly. Many silver mines produce silver as a byproduct of mining for copper, lead, or zinc. That means production often depends on conditions in other mining industries. Even if silver prices increase, companies cannot immediately boost supply. Building new mines requires years of exploration, permitting financing and construction. This limited flexibility has attracted increasing attention from institutional investors. If industrial demand remains strong, while investment demand also increases, the silver market could become significantly tighter. This possibility explains why many analysts believe silver deserves much closer attention during the years ahead. Central banks also continue influencing precious metals. Although they primarily purchase gold rather than silver, record levels of central bank gold buying demonstrate that official institutions continue valuing hard assets. Many countries have been increasing gold reserves as part of broader diversification strategies. That trend has strengthened confidence among private investors who also view precious metals as long-term stores of value. Geopolitical uncertainty remains another powerful force. Trade tensions, regional conflicts, energy security, supply chain disruptions, political elections, and diplomatic disputes all contribute to changing investor sentiment. Periods of uncertainty frequently increase demand for assets perceived as stable and reliable. Gold has historically benefited from this behavior. Silver often follows when broader precious metals interest expands. The key lesson is that no market operates independently. Japan's bond market affects currencies. Currencies affect treasury yields. Treasury yields influence. Federal Reserve expectations. Federal Reserve expectations impact the US dollar. The dollar affects gold and silver. Everything is connected through a complex network of global capital flows. This is exactly why today's developments deserve close attention. The headlines may focus on Japan, but the real story involves the entire global financial system. Markets are asking whether decades of extremely low interest rates are gradually coming to an end. If that transition continues, investors across every major asset class may need to adjust their expectations. For precious metals investors, this environment creates both opportunity and uncertainty. Understanding the larger picture may become far more valuable than reacting to daily price movements. The biggest lesson from everything we have discussed is that financial markets are entering a period where old assumptions are being tested. For many years, investors became comfortable with extremely low interest rates, abundant liquidity, and stable bond markets. That environment shaped investment decisions across the entire world. Today, those conditions are changing. Japan represents one of the clearest examples of this transition. For decades, its bond market appeared almost perfectly stable. Now, investors are watching rising yields, changing monetary policy, and shifting capital flows. Whether this becomes a temporary adjustment or the beginning of a much larger transformation remains one of the most important questions facing global markets. The United States is also approaching a critical period. Government borrowing continues expanding. Treasury issuance remains elevated. Interest rate expectations continue evolving. Inflation has moderated compared with previous highs, but policymakers remain cautious. Economic growth has remained resilient, although some sectors continue showing signs of slowing. Each new economic report now carries greater importance. Employment numbers, inflation reports, retail sales, manufacturing activity, consumer confidence, GDP growth, treasury auctions. Every one of these releases has the potential to reshape investor expectations. Markets no longer react only to today's data. They react to what today's data may mean for tomorrow's policy decisions. That is why expectations often move prices before actual events occur. Gold investors understand this better than most. Gold has survived every financial cycle because its role extends beyond short-term speculation. It represents confidence, security, liquidity, and long-term purchasing power. Whenever uncertainty increases, investors naturally begin reconsidering how much exposure they want to traditional financial assets versus physical stores of value. Silver remains one of the most fascinating opportunities within the precious metals sector. Unlike gold, silver benefits from two powerful sources of demand. Investment demand increases during periods of financial uncertainty. Industrial demand continues expanding as technology advances. Electric vehicles continue requiring more silver. Solar energy installations continue growing worldwide. Artificial intelligence infrastructure demands advanced electronics. Medical technology relies on silver in numerous applications. High-speed communication networks also require silver because of its exceptional conductivity. These long-term trends remain firmly in place. Supply, however, continues facing challenges. New discoveries remain limited. Mine development requires years of planning. Environmental approvals take time. Production costs continue increasing. Many operations depend on other metals because silver is frequently produced as a byproduct. This means supply cannot rapidly respond if demand accelerates. That combination has attracted increasing attention from institutional investors around the world. One factor many people underestimate is psychology. Markets often move because expectations change before economic reality changes. If enough investors begin believing bond markets are entering a new era, they adjust portfolios accordingly. Those adjustments themselves influence prices. This feedback loop has appeared repeatedly throughout financial history. Confidence creates stability. Uncertainty creates volatility. That is why headlines about Japan's bond market deserve attention even from investors who never buy Japanese bonds. The implications extend far beyond one country. They influence currencies, interest rates, capital flows, government financing, corporate investment, consumer confidence, and eventually precious metals. Central banks will continue playing an important role. The Federal Reserve, the Bank of Japan, the European Central Bank, and other monetary authorities all face difficult decisions. They must balance inflation with economic growth, support financial stability while maintaining credibility, encourage investment without allowing excessive inflation to return. These objectives often conflict with one another. That makes future policy decisions increasingly challenging. Markets understand this complexity. That is why every speech, every policy statement, and every economic forecast receives enormous attention. Looking ahead, investors should continue monitoring several major indicators. Watch Treasury yields closely. Observe movements in the US dollar. Follow inflation trends. Pay attention to employment reports. Monitor Federal Reserve communication. Keep an eye on Japanese bond yields and continue watching central bank gold purchases. Together, these indicators provide valuable insight into where financial markets may be heading next. For gold and silver investors, the message is straightforward. Avoid making emotional decisions based on daily headlines. Focus instead on understanding the broader forces shaping the global economy. Successful investing has always required patience, discipline, and perspective. Short-term volatility often creates long-term opportunity for investors who remain informed and avoid panic. No one can predict every market move with complete accuracy. But understanding the relationships between bonds, currencies, interest rates, inflation, and precious metals provides a significant advantage. The story unfolding in Japan may ultimately prove to be one of the defining financial developments of this decade, or it may simply represent another chapter in an ongoing adjustment to a higher interest rate world. Either way, experienced investors know that paying attention today is far better than reacting tomorrow. We will continue following every major development affecting gold, silver, bond markets, the Federal Reserve, the US dollar, and the global economy, so you always stay one step ahead of the market. If you found this analysis valuable, make sure you subscribe to Silver and Gold Watch and turn on notifications so you never miss our latest updates. Leave a comment below and tell us whether you believe Japan's bond market is sending an early warning to the rest of the world or whether this is simply a temporary adjustment. If you enjoyed this video, please give it a like and share it with friends and family who want to stay informed about the future of gold, silver, and the global financial markets. Thank you for watching, and I will see you in the next video.